And looking at the charts this morning, this is probably not what you may have thought from a baseline point of view that you'd be looking at this morning. Obviously, we had a bit of a sell-off, if you like, in Europe or US equities, kind of late in the day. If I go back here in the middle right chart, you can see that when really Europe closed cash markets yesterday, the S&P started to drift lower, and fairly quickly. I was still in the office at that point, and the kind of feeling there was that everyone was coming round to this prospect that potentially, with all the hype, Trump might not deliver, and therefore, we're due for a bit of profit taking off these more elevated levels that we've had in US indices of late. However, as per usual, the ship steadied, if you like, in towards the Wall Street close, and then Trump speaking. Equities have probably been not a great deal of reaction since Europe has come in. Obviously, the DAX has gapped up and moved higher. Likewise for all European indices, the Eurostoxx future higher as well. But the more notable movements are in fixed income, with the markets pricing, as I'm sure you've read from the research this morning, now up to 80%. You heard me right, 80% for a March hike is now being priced in by federal funds futures. So the dollar is much stronger this morning post-Trump, up 0.4%. Consequently, both major currency pairs are lower. 60 pips in the case of euro dollar, 32 in cable. Just testing and having found some initial support here at S2 in the euro dollar pair. The DAX, though, positive move, and I guess eyeing back up to the 12,000 level should we continue moving higher, and that brings into play then last week's high. That was at 12,030, that marker. Yes, from a slightly longer time frame, ever since we had that quite aggressive move lower on the 24th last week, and then we hit that pretty strong technical level that was resistance and support over February. We've kind of bounced from thereafter, and now this latest Trump-inspired kind of move that we've had. So, okay, what did he say? And why has the markets perceived and moved the way that they have? Well, it was almost a bit of a rerun of the morning when he won the election. In this conciliatory language that he was using, the tone, what people will refer to as he was a little bit more presidential in that respect. Something, of course, in which we are completely not used to. In terms of I talk about market participants. The guy from the press conferences that he's been holding with reporters on a daily basis, media meetings that he had or has had in the past, his tweets, of course, all tend to be fairly far-reaching in terms of him being an opinionated fellow. An event like this, though, he knows that historically of its importance for the financial markets. I was reading some stats about Obama and about Bush when they respectively delivered their session after being voted in as president, and actually this was a very definitive part of what shaped then their governing policies thereafter and eventually got signed in. So he knows the gravity of the situation, Trump. Some would argue that all of this, the way that he is a little bit of a showmanship, if anything. And so he's managed the tone, I would say, exceptionally well in this particular instance. And it seems to be that it's the tone that has negated somewhat the fact that he's made America wait again, in regards to that's the phrase being coined on Bloomberg, and that it was once again lacking on details. And that was what we were fearing yesterday, that after all the promises, after all the hype that he's been saying, and the tweets earlier or at the end of last week, that he had failed to deliver, he would underwhelm. But he's managed to actually play that off against sounding quite presidential, it seems, and the market has liked that in terms of their response. A little bit more on the details then. On the subject of rebuilding infrastructure, he'll be asking Congress to approve legislation that produces a $1 trillion investment. Don't forget, No details on how exactly that's going to be achieved, but at least putting a number on it, I guess. He also reconfirmed intends to repeal and replace Obamacare, increase defense spending, enforce immigration laws, and also overhaul tax, including cuts for the middle class. The tax subject, which obviously has been a real big issue for the markets, particularly in corporate America on the corporate tax elements, where he's been hinting towards a phenomenal deal. It was only really a light touch in terms of, again, not much more concrete evidence about the timeline and specific numbers associated with his plan. So yeah, it's a bit of a mixed bag really, and I'm a little bit hesitant to really buy into the Trump and that this positive reaction is down to him too much. And by that I mean that if you think about it, I talk about economic data quite often about market positioning, i.e. pre-positioning. This is where you might have a median consensus for a figure, but there's a whisper number given pre-events that have happened, which means that the market is positioned for a slightly negative outcome, let's say. And I think that was definitely the case with yesterday. Asset prices are generally quite inflated, and people were expecting him to underwhelm. I'd say that was the broader consensus, at least from the poll that we did yesterday on Twitter. That was definitely the vibe that I was getting from you guys. And I think that was kind of broader for the market assessment as a whole. You had Mohamed El-Erian talking about a similar thing yesterday. Then what's happened is he's basically delivered something which is net neutral, positive on the tone but lacking in details. But we were looking for an underwhelming event, and that hasn't really occurred, and therefore it's a net positive, if that makes sense. That's kind of how I see the reasoning behind why equities haven't fallen out of the bed this morning, and in fact they've actually risen, because he's not done anything shockingly bad, which I think people are getting more and more of that expectation. I do have a bit of a question mark though on how this will then be perceived if he continues to delay and not give or be forthcoming with more additional information about specifics, i.e. corporate tax. How low is it going to go? Who's it going to affect? How's he going to implement it? How's he going to finance the budgets? And all these types of questions. At some point, the market will lose patience. Now, arguably, actually, the bigger thing that occurred last night was not actually Trump. It was this chap. Some of you may not know this fellow, William Dudley, the head of the New York Fed. Now, of course, Dudley is particularly influential in terms of the Fed. Now, if it's not Janet Yellen, then this guy pretty much sits at the helm alongside her as her right-hand man, so to speak. So when he talks, the market listens. And now that's important because yesterday, let me just read to you some of the comments that he made in an interview with CNN. He said that the usually dovish, and this is very important as well, this is a typically dovish person. His thinking, being the vice chair of the Fed, is closely aligned with Yellen, who tends to be cautious and dovish in nature as well. So keep that in mind when we cover his comments here. He said the case for tightening has become a lot more compelling in recent months, and that risks to the outlook are now starting to tilt to the upside. He was quoted as saying that the animal spirits have been unleashed a bit post-election, and there's no question sentiment has improved quite markedly. Now, these are comments from a dovish policymaker, and not just a policymaker, but the second most influential after Janet Yellen herself. So that really prompted quite a dramatic move in yields and the dollar. So when you're looking at the market's reaction, yes, there's Trump and that event, which may explain the equity move more so. But if you think about the Fed situation, looking at bunds, we're down 30 ticks. We gap lower. Why did that happen? Well, T-notes are down 17 ticks. So when Dudley's comments hit, which was towards the latter part of yesterday, let me just make this chart a bit bigger. This is T-notes here. Look at the T-note trajectory last night. Came under an assault to the downside. We moved from pretty much 124.24 all the way down to sub 124 handle seen overnight. This is the market. Well, hold on, let me just. So there's my T-note chart here. So this move here is when these comments were coming out. Now, before I get into the move, let me just cover this off, because it was not only William Dudley that spoke. San Francisco Fed President Williams said the March hike is getting serious consideration given that the Fed is very close to achieving its dual mandate goals. So that's a duo of Fed speakers being extremely hawkish. And so yields spiked higher on these comments. So the bond price moved sharply lower, and that prompted the short end, the 30-day federal funds, to then reassess their expectation for the probability, percentage-wise, of then the chance of a rate hike in March occurring. What does that mean for the dollar? Strength, immediate strength for the greenback. And if we look where we were yesterday, around when we left, we were trading around a 100.8 in the dollar index. We're now up at 101.8. Consequently, the reason why both your major currency pairs are under pressure this morning. March Fed hike is now right on the table. It was kind of hiding under the cover beneath the table. Now it is right bang square in the middle of the table, ready to go, with a big red button flashing on it. Now, will that happen or not is still a little bit yet to be seen. What I would say is that March hike probability is at 80% as of this morning. It was 52% yesterday. It was 40% at the end of last week. That is a phenomenal change in market pricing of expectation over that period of time. I can't really remember time recently where I've seen it fluctuate so much in such a short period of time. Vas and I were having a chat earlier. This does sound a little bit familiar to September of 2016. Now, just quickly, for those who weren't trading then, so for the newer guys, what happened then was the Fed was still communicating that potentially they could have still multiple rate hikes at that point. Then we were looking at, well, if they're going to deliver two, then they're going to have to do September and December, i.e. when they have the summary of economic projections in the Yellen press conference. So September was on the balance, if you like, of whether or not they would do something. What we saw there was the market was very lowly priced for September hike occurring. But the Fed, as we know, like to keep their options open. So in the 2 weeks before that decision, all the Fed members started coming out being uber aggressive, being super hawkish. Then the market started to reprice the chance of September, which actually got to a point of about 50-50. Ultimately, they didn't. They didn't do anything. And it was more of a dovish conference, but then they indicated then that they would be looking at December, and then ultimately they did move rates in December. So they kind of kicked the can down the road. But it does feel a little bit similar to that situation. Maybe they were a little bit disappointed by the fact that odds of a March move were on the low side, and they actually wanted to manage expectations a little higher just to keep open the prospect of maybe doing something. The interesting thing what Dudley said, and I think the reason why the markets have jumped on it so much, is that he specifically has said that federal policy makers have insisted they do not need to see Republican tax reforms and other policies before they act. Now that's really important, because if you think about what has been hampering the Fed making that March decision, which from an economic data point of view, i.e. the health of the economy, on that basis alone, the Fed should hike. The problem is they do not have clarity as yet as to what exactly Trump is going to do. Now that's when I go back to the Trump speech last night and I look at the clarity side if I were a central banker, and I still don't really have a lot of information. That's why I think the 80% at the moment is a little bit overbaked, and I would be expecting that 80% probably to come off a little bit in the coming days. That being said, who's speaking on Friday? Can anyone tell me? Anyone who's astute with their calendar and knows their Fed schedule will know for sure who I'm talking about. Yep, Darren, Nicholas, right on the money. Janet Yellen is speaking this Friday. That for me now carries a whole new degree of importance. So I want to know from the Fed chair, where does she stand? Because she's the ultimate, let's say, decision maker. She would carry the most weight then in terms of a signal. Because if you look at the calendar, in terms of when, let me just flick my screens over. On the right hand side here, you can see my calendar. So Yellen speaks on the 3rd of March, Friday. Definitely in the context of this uber hawkish Fed commentary, I want to know what she has to say. So that's going to be important. Then the Friday after, what do you get? US non-farm payrolls. Remember, payrolls is not coming out this Friday. It's coming out on the 10th. So that's a very key employment number to look out for the decision making on March. Remember the previous payroll number? I think I'm right in saying that it was a headline beat. However, the other metrics were disappointing, particularly on the wage growth side. Then you go into the Fed blackout period ahead of their decision, which is on the 15th. So basically you've got Yellen speaking on Friday, and then the Fed blackout period starts, I think, from the end of Monday, because then they have a 2-day meeting which begins on the 14th with the decision on the 15th. So Yellen is the last chance saloon, if you like, for the Fed to really give a concrete signal if they are going to give, if they're going to do something in March. Then you have non-farm payrolls as well, which, given the more weaker report that we had on some of the underlying metrics last month, I think will be critical then as to the chance of this March occurring. So this 80%, that's fine for now. That will change given these events that I've just discussed, and the market will have to move accordingly. Okay, a few other things to quickly look at to wrap up the briefing. You have had some Chinese data overnight. I'm not going to dwell on this too much because the market hasn't really paid much attention given the US focus. But China's factory gauge strengthens as producer prices rebound. The manufacturing PMI 51.6 was a little bit higher than expected. However, slight decline in non-manufacturing, but the private manufacturing reading by Kaizen Media and Market Economics, that climbed to 51.7. So pretty solid numbers actually coming out of China. And if you were thinking about the reasoning why the Fed fell so far short of their mandate of hiking 4 times last year, a predominant part of that was China, and certainly for the first 3 months to 6 months of 2016. Whereas China at the moment is proving to be fairly stable in terms of its economic data, and this, to put in context, comes at quite a key point in time for China domestically, because the National People's Congress starts this weekend. For those who aren't aware, this is basically the biggest event in terms of economics, the economy and monetary policy from a People's Bank of China point of view, who are much more tied to the government and what the government's agenda is. So this is a very big event for them, and it's coming in a backdrop of a fairly healthy economy, with some people suggesting then that China could soon be on the path to tightening in whatever shape or form that might eventually take. The other thing we had last night, and again it's been overshadowed to some degree, but you did have the API crude oil inventory numbers. This of course front runs the DOE numbers we'll get Department of Energy later this afternoon. So you had a headline crude build which was roughly in line with expectations, a build of 2.5 million, Cushing a build of 544,000. It was actually the gasoline number that stood out. That was against expectations of a draw of 1.5 million. We had a build of 1.84 million, and distillates was a draw of 3.73. So on the balance, I would say this is erring on the side of being slightly bearish, in that we've had another build. That's the 8th week in a row, albeit slightly shy, but the bigger differential from expectations came in the gasoline, which was a bearish figure. Again, we'll cover these closer to the time when those figures are released this afternoon. Another thing quickly just to share with you that I saw this morning was this graphic here. And as it's the 1st of March, obviously there's some really big events upcoming to be aware of. So a couple of the key things to look out for. As I just said, if you were to plot the 3rd of March here I'd have a little picture of either my nan or Janet Yellen. Either will suffice. But you'd have Janet Yellen here, then you have the ECB meeting, then you have the US jobs report, non-farm payrolls, and then that key March Fed meeting, that's on the 15th. That also coincides with the Dutch election, and some have said that it's going to be around this period where the government might look to trigger Article 50, which we're obviously still looking for a definitive date, but obviously by the end of the month, all being well, or as planned I should say, that should be also done. So there's a couple of key events here. This FT article goes into some details about each one. I did send that out to you earlier this morning, so please take a read when you have time. Okay, quick look at the calendar. It's actually a fairly busy schedule. A couple of the manufacturing PMIs have been coming out this morning. Just casting my eye on them. The French figure basically in line. The Italian figure stronger than expected, 55 against 53.5. You've had some German inflation numbers, the regional state of Saxony, year on year 2.4% against 2.3. So maybe if you look at the euro just taking a little bit of a bounce off that S2 here, a more recent trade, just negating some of the weakness derived from really dollar strength, if anything. But the latest data here from Germany would show that inflation is still tracking up. In terms of the German manufacturing PMI, that's just come out as I've been speaking, 56.8. That's broadly in line, if not a touch softer than expected. Unemployment rate in line at 5.9%. The unemployment change, minus 14,000, which is a slightly better figure. Remember, it's unemployment change, which is a negative, which is actually a positive situation for the employment side. So, a couple of data points. Equities still residing up at their highs. R2 now being tested in the S&P. So we're up here at 23.75. If we start looking at this from a longer dated perspective, these are, of course, fresh highs. So it'd be interesting to see when the US come in how they react to this on further digestion of what's happened both with the Fed repricing and the Trump comments. Quickly, just back to the calendar. That's kind of encapsulated most of the morning of what we've already seen. You get the various other state or regional German CPI numbers. Keep an ear on those if you're trading things like the euro. 9:30, you've got the UK manufacturing number and mortgage lending, mortgage approvals. So sterling traders, be aware of that. The pan-German number, as ever, is not going to be market moving given the fact that the regionals will know. So better advice would be to keep an eye on these Brandenburg, Hesse, Baden-Württemberg to see if any discrepancies from Saxony already seen. Then in the afternoon, you've got the manufacturing PMI in the States, but the headline reading will be ISM manufacturing. FX traders, you've got CAD, interest rate decision and policy statement. And then oil traders, the crude oil inventory numbers. Layering in with this, you've got ECB's Weidmann, who's the hawk, who sounded a touch dovish actually at the weekend. Be interested to hear his comments. And then obviously open on Wall Street. You'd be interested to see with these equity prices back up at these all-time high levels again. Final thing, just to round things off. You may not have seen this this morning. I did tweet it from the Amplify account, but our friends at Randsquawk have started doing their own blog, and the main point of this is that they're going to post this at 7:30 every morning, and basically it has a little audio bar that you hit here, just press play, and that's a 2.5-3 minute recording of their rundown delivered at 10 to 7 in the morning. So if you guys are on the way to work or on the way to the office, then you can have a listen to that little soundbite. I think they're going to tweet it every day. It's just quite a good little earshot to get an overview before you even hit the desk. It also has all of the overnight major headlines, kind of like the one that I put in the chat in the morning, but in a bit more detail. If you read all of that and you listen to the audio soundbite, I would say you're pretty good to go as soon as you get into the office every morning. Okay guys, that's your morning briefing. 9 o'clock coming up, so I'm going to leave it at that. and I'll see you in the chat room. Thanks very much.